Welcome to Industry Focus, the podcast that dives into a different sector of the stock market each day. It's Monday, March 18th, and that means we're talking financials. I'm your host, Jason Moser, and on today's show, we're going to talk about Wells Fargo. Did their CEO really deserve a raise? Well, we're gonna kick that idea around. We've got a good listener tweet to discuss too. As always, Matt and I will have one to watch for you, but we begin today with a new installment of Between Two Fools. Rob LoCascio is the founder and CEO of LivePerson. As the leader in intelligent engagement solutions, LivePerson currently serves over 18,000 clients with 1,200 employees and offices across the globe. Recently, I had the good fortune to speak with Rob, and we talked about everything from the intended and the unintended effects technology is having on the world to life as a CEO of a publicly traded company and why he's excited about what the future holds for LivePerson. Okay, Rob, customer service is hard. You founded this business, LivePerson, on that very concept back in 1995. What I'd like to know is, first of all, tell me how I, the consumer, might interact with LivePerson on any given day.
For, let's say, a customer of T-Mobile, you can now, through iMessage, right on your mobile device, you can message, you'll see T-Mobile's there, and you can message them like you were messaging your friends and family. And even, I just saw they just put in that when you go to their website on your mobile device, on your iPhone, you'll see a little, say, message us. You click on it, and it also opens that on iMessage. So you no longer have to, like, make a phone call or even find chat, although I invented chat back in 1997. You don't have to find a chat button on a website. Right from your mobile device, you can message a brand, and you can do it on your own time. You know, you message, maybe you're in a meeting, they get back to you, but it really puts the control of customer care in the hands of the consumer, which I think we've all been waiting for versus being put on hold.
And what was the idea there? I mean, how did you start this? What was the idea that really got this thing going?
You know, it's like every entrepreneur, usually there's an event that happened, and then you thought, why can't I change that? And it happened that it was, you know, I was shopping on the website of Dell Computer, and I was looking for a computer, and I configured it online. And then I needed to basically ask a question, and I picked up the phone because they didn't have anything online. And at that time, I had to actually hang up my connection to the website. And then the person on the phone made me do everything over again that I spent an hour doing on the website. I thought, that's weird. Why can't I just point at if I'm living in the digital world and I'm doing commerce in the digital world, why can't I converse in that digital world? And that made me invent the technology of web chat at the time, and basically built the company around it from that point forward.
Yes, I mean, I was checking out your investor relations site. I mean, I've been checking that out periodically here since we've been covering the company. But I mean, right there on the bottom right of the screen is that little chat bot, that box that says, "Hey, you know, how can we help you?" or something. I mean, that is essentially what you guys are doing, right?
Yeah, I mean, but we really, like I said, I came to the conclusion about 5 years ago that web chat was not going to do it, because even at our largest customers, about 5 to 10% of their volume would go through there. And still 90% of the time, 95% of the time, the consumers had to go and make a phone call.
Yeah.
And so when I saw, 5 years ago also that messaging, I was messaging my friends and family through Facebook Messenger and SMS and WhatsApp and all that, I thought, man, consumer behavior has changed. Like, we don't talk to people anymore.
No.
And so, well, why can't I do that with a brand? And that led me to this next innovation. You know, I often think I'm kind of blessed that I was able to create this thing called web chat, and it did a lot of good in the world, I think. But I kind of have a second time around developing and pioneering something that I think is going to have a greater impact on the world of customer care, definitely in customer care, but especially, I think, just broader impact on what we call conversational commerce, the ability to have a conversation with a machine and get something done with a brand through a machine or with a machine. And that's the stuff we're going after. It's really big stuff.
Yeah, I love that idea. I mean, you're giving brands an opportunity to really take their customer service to the next level. And you're right. I mean, it's totally changed from when we were growing up. I mean, I would much rather interact via chat on my own time as opposed to having to sit there on hold. Now, when we talk about brands, I mean, now our show on Industry Focus here, we like to focus a lot on the financials industry, and talking about banking and payments and insurance companies in particular. And so for us, I mean, when we look at how technology is changing that space, and it's changing the space in all sorts of different ways, but I think that your technology is certainly helping them up their customer service game. Can you talk about any of the things going on in the financial space in particular that have you excited about the future?
Yeah, we have some of the biggest banks in the world, insurance companies. We have Citibank and HSBC and American Express and companies like this. But I got a really good story of there's a bank called Buddy Bank, which is a division of UniCredit. UniCredit is one of the top, I think top 10 or 20 banks in the world. It's definitely in the Fortune 500. And it basically they decided to launch a bank that was all about the connection with the consumer and this idea of a concierge service. So this Buddy Bank is basically like your buddy, and your buddy helps you like book reservations into hotels or restaurants, get you tickets, do things, and you also can bank. As in, what they really figured out was that, okay, we do credit cards, we're doing loans, we're doing everything, we're a bank, but people are buying things. They're buying cars. Why don't we try to help them buy a car? And then we're going to get the transaction of the loan to a car. Why don't we help them find a restaurant? Because they'll use our credit card. And so they proved out that conversational banking is really what I think is the real future. And that's about personalizing the experience with the consumer. And it changes the game, as in, banks are just more or less places to do transactions.
Yep.
Okay, you got a low interest rate, I'll get my mortgage there. I'll get my credit card here because you're giving me some points. It's a commodity. And what banks are looking for is an ongoing relationship where every day you're going to want to do something with me. I have your student loans for your kids. I'll give you your car loan. Don't go any other place. But today it's very loose. We as consumers think, who cares about a bank? I'll go wherever the interest rate is or the points are. And he proved, the CEO over there, Angelo Alessandro, he's the CEO of Buddy Bank, he proved that this can be differently. A bank could be radically different than what we think a bank is.
Well, I mean, I think you said the key word there in personalized, and that really takes me to my next question, because, I mean, we live in this day and age where data is everywhere. And I mean, you said it yourself, your data is your moat. And I mean, obviously, today, privacy means something completely different than what we knew growing up. I mean, privacy has become a very hot button issue these days. And I mean, to be clear, not only do you have these big customers, you just listed off a few major ones there, American Express and Citibank, but you're also partnering up with a lot of the big players in the tech space like Facebook, Google, Apple. And we've seen how this privacy conversation has taken place with all of these names. And given that your data is your moat and you're working with these companies and sort of the age we're living in now with privacy being such a hot button issue. I mean, what are some of the challenges and the opportunities in making sure that data stays protected, not only for the consumer, but for you as well?
The thing that I think makes us very different than most technology companies in the world is we really are representing the brands. So the brands are our customers, and then we're B2B2C. So the brands are on our platform, and their consumers come through our platform to reach them. And we always have to adhere to what the highest level of security and personal data is, and managing all that from the brand's perspective. And believe it or not, the brands have a very high bar, because if I'm a bank, I'm working at some of the highest levels when it comes to privacy, when it comes to security, because I know if that gets broken, you as a consumer may leave me.
Yeah.
And so we always take it from their perspective. We actually run our own clouds. We run 6 clouds around the world. We can't be on Amazon Web Services because they're not even secure enough for the conversational data we have.
Oh, no kidding.
So we since the beginning, we've always run our own clouds, because banks won't bank with us. They won't be on our platform. So these are the things that we look at. And we look at once again, the consumer. If someone is coming in and having a conversation, and we have to secure that. If a consumer puts in, for instance, personal information into the messenger, we what we do is we mask it, and then we encrypt it, and then we transfer it. And we've done that from the beginning. So we have a very, very high bar, because the consumers are not products to us.
Well, I mean,
like,
that's
to the Facebooks and stuff. A consumer is a product. To us, they're not products. They're part of the conversational, they're part of generating the conversation. We got to protect them and that conversation.
Yeah, I mean, I'm sure that puts the consumer at ease there, knowing that. I mean, I didn't realize you guys ran your own cloud infrastructure. That's interesting.
Yeah, we've done that since the beginning. Yeah.
That's actually, man, I tell you, I didn't realize that. That is, I mean, I would think that, you talk about your data being your moat, and that really is the ultimate way to protect your moat. Even if you have to pay a little bit more for that, that really does give you that added sense of security, doesn't it?
Yeah, because we are a premium platform, so we get a lot of money to work with our customers, and we provide a lot of value. But that value and that value chain comes from everywhere from it's from the network operations all the way up to we're always innovating. We're the first to do things in the world. I don't copy other people and try to make things cheaper or faster. I try to I've always run a company where we're inventing new things and working with the customers, and more importantly. And I've seen this, especially in the last 2 years since we launched the messaging platform. Like, I'm so proud that our customers are what I call firsts. They're all very proud to be first at doing something. T-Mobile was the first brand in the world to go scale with messaging. Citibank was the first bank to do messaging through Google and what they call RCS on Android devices. Vodafone Germany was the first company to do to go scale at WhatsApp through the contact center, from voice calls to WhatsApp. And there's so many firsts. We've got a guy out there who works for Aramark, and we're doing the first in-stadium ordering of food and beverages from your seat with messaging and bots. So in order to do firsts, we always have to be running at such a level of expertise and quality, because we're trying to get people to do things in their own organizations that are going to put them on the line. They're innovators, and we can't fail them.
Yeah, that's a really, I was thinking about that. I mean, given the nature of your business, essentially the nature of your business is understanding customer service, being able to put that customer first. You understand how hard it is. You understand how to do it well. And when you do it well, that's got to really, the customers that you're bringing in, then they recognize that and they want to stay with you. And I would think that just creates this almost virtuous cycle that just continues to grow. And you, I think, establish that moat over time to where not only your data is your moat, but really the service that you're providing your customers is too.
Yes. Yeah. And that's why, once again, I think we take an extra special view of the consumers, our customers, their data, the quality of our service, and cutting edge. Like, every time we're out there making something new, I often say, you can get pretty beat up because you're putting out new technology, but we're constantly, even if we're doing cutting edge stuff and new stuff that's never been done before, we got to keep improving it every day, and we work very hard at that. That's why we have the biggest brands in the world. That's why they trust us to provide a customer-consumer experience. Like, we're enabling their consumers to connect with them. In some cases now, we have 30 to 40% of their consumer interactions are going through our platform over voice. And that's a lot. And they're like, you cannot fail. You have to be able to provide a high-quality service in this world that you guys have created.
So as a CEO, as a leader of this company, how do you combat that short-termism on a quarterly basis? Because you got to get out there, you got to release that earnings, and then you got to go do the call. And I mean, I've read the earnings, I've listened to the calls, and you're able to paint that picture of a longer-term road to success. I mean, what are some of the things you do to combat that short-termism?
I mean, I'm founder CEO companies, as you know, usually are the best performing companies, because it starts with, I'm still the largest shareholder in this company. And that's been that way since I founded it. And so I have a lot to gain and a lot to lose. And so I'm aligned with our shareholders. Now, the difference is that, I can't go in and out of my stock every week. You know what I'm saying? Right. I don't trade my stock like that. And if you're a fund manager, you can trade in and out of our stock, and you have the right to do that. And that's a different business model. So I think by nature, I'm always thinking about what can I do to maximize the value of that. And sometimes it is by the quarter. I will live by the quarter. Like right now, we're living by quarters because we are in pure execution mode. Right. I'm not living by it because I think I'm trying to live by what you're talking about, the quarterly thing, because I think we need to deliver very quickly now results, because that'll make us win the game. Now, if you dial back 5 years ago, you'll see me, I cut earnings in half.
Yep.
I went through we went through a very painful public experience of like people not believing in us, analyst stuff. We had shareholders come in, but I found I just was straightforward. Was just straightforward. Here's the vision. That's what we're going to try to do. Sometimes I could not paint the vision because for competitive reasons, I don't want to give out everything 5 years ago.
Sure.
So I think you kind of go through this concept of at the end, and that's how I always think about it. At the end, whatever that end is, I believe that this company will be worth, billions and billions of value to the shareholders, including myself, like multi-billions. I think this company could be one of the biggest companies in the world. That's how I've always tried to run. Now, we're not right now. I get it. But if you work with that viewpoint, you're constantly trying to change, improve yourself, improve the company, and then work towards that longer thing. Today, we look great. We're at an all-time high, and I know that. And I know that could be very short-lived, but our vision is not short-lived. We've always been committed to it as a company, for right or wrong, or short-term or long-term. We've been committed to a vision that we will digitize communication between brands and consumers. We will make that easier. We will give consumers their time back, and we're going to change the way in which that experience happens, and we're going to be the leader in that, and that just hasn't changed. So we're committed to that. As long as I'm here, we're committed to that vision.
Yeah, and that's a really good point. We always love to see founders with skin in the game. I mean, we just like you said. I mean, you're acting really. You're aligned with shareholders because you essentially are the same as them, and you can't get in there and trade in and out of that stock on a quarterly basis. So you have to take that long term view, and that's good, because clearly you go 5 years ago. Yeah, you guys were in a little bit of a bind there, but if you look over the course of that 5 years, hey, you know what? You're outperforming the market, and it looks like things are only getting better. So I mean, you're doing something right.
Yeah, and I'd like to think, we all have purposes in life, and I know there's also just short-term. Look, we're very much living in a world of short-termism.
Yeah.
As in, everything looks like in 5 years you're a billionaire. Everything's about billionaires and tech billionaires, and 5 years, and you're going to be the next Facebook. And why aren't you the next Facebook? And why aren't you? And trust me, even for myself, I've heard a lot of that over years. Like, why did it take you 20 years doing this? Why aren't you bigger? Why isn't this company the size of Salesforce? In my world, it's always Salesforce.
Yeah.
And I'm like, I'm not Salesforce, and I don't want to be Salesforce. And I admire Mark, and he's done a great job with Salesforce, but that's not our destiny. Now, at the end of this whole thing, if we get to where I think we get, I think everyone will be very happy, and I think everyone will be very proud, and I'll be able to show the world that if you put in the time and you're committed and you're persevering, that ultimately you will reach your goal and you will get to where, and financial rewards just follow always. Market caps follow with good. If we do good for our customers, our market cap will follow. And so that's my thing. We just on a different journey. Our journey was never about 5 years. If you looked at us from the beginning, you guys have been following us actually from the beginning, when we went public, after we had to restructure the company during the dot-com downturn, all of that. We've been through a lot to get here, but that makes us prepared for the big things. And we're here today, I think, looking at the big thing. We're staring at the big thing, and that's conversational commerce.
That's great perspective there. Now, let's pivot a little bit. I want to talk about something I know you're really proud of, and I can understand why. And our listeners, I know, will love to hear about this. You're involved with an initiative called the Equal AI Initiative. Is that right?
Yeah, so Equal AI. Yep.
Tell us a little bit about that.
So Equal AI is, obviously we're using a lot of AI technologies. I think we've done a really good job at getting people in organizations who normally wouldn't be exposed to this. In our case, we work with contact center reps, and they're the ones creating bots. They're the ones using AI, which is really unique. You would think only basically data scientists and engineers can use AI, but we built our technology so the people in the contact center can use this technology to better their work. So I started to see that there's a lot of challenges with AI in the world, it's in many different places. Everything from Amazon Alexa, we talk about gender. It's a woman. It's a woman's voice, and why was that created? And now we know there's problems with children watching their parents give commands to this woman in a machine. And we know the bias with data sets. There's all this bias with data sets, and we're reading about this every day. Well, I kind of was like, instead of just watching this from the sidelines, I said, let's create an organization. Let's bring people together. We got Jimmy Wales, Wikipedia, and Ariana Huffington. And then I brought on Marian Bogle, who's worked for President Obama, and she ran the bias training programs for the federal law enforcement groups, DEA, FBI. She created all the curriculum for that. And I said, let's get ahead of this. Let's start to create some frameworks, and let's invite people in. Let's invite companies in. Let's invite other leaders in. Let's invite a diverse group of people to help shape how this could be, because it gets a little tiring hearing Elon Musk talk about how AI is basically the existential threat to humanity.
Yeah.
Like, I get it, but there's also a lot of things that can happen as long as we're more transparent about it and we don't leave it in the hands of just technologists behind the technology door. And that's our goal with Equal AI.
That's great stuff. All right, listen, I want to be respectful of your time here. I know you're a busy guy, but I'm going to wrap this up. And the way we like to wrap up our interviews is we're big readers. We love to read. Our listeners love to read. We're always looking for a good book to read. And so I'm going to ask you, Rob, do you have anything good you've read lately, a book recommendation that we might want to go pick up?
Yeah, I mean, I'm reading a couple right now, but I'm reading the book Zucked, which is the Roger McNamee book you probably know about, the one, Zucked, Waking Up to Facebook's Catastrophe.
Yep.
And I think it's important for, especially being a technology leader, to read a book like this, because I fundamentally believe, like he does, and I don't want to make a comment on Facebook or Mark Zuckerberg. I don't know Mark Zuckerberg on that level, and I think he's built an amazing company. But there's something fundamentally wrong with the technology leadership today, that leadership, the Googles and the Facebooks and Amazons and even Apple in certain ways, in that I grew up with an era, I'm 50, and I grew up in an era where it was Bill Gates and Larry Ellison and Steve Jobs and Scott McNealy and these guys, Andy Grove. They were my heroes, and they were ruthless competitors, but they were always working towards building these great companies, but it wasn't at the expense of I would say society in many ways. What they may have, they competed with each other. They were ruthless in many ways. Obviously, Microsoft in some ways, the government stepped in on them, but you always felt they were trying to give the world things that would make our lives better. And I don't feel like they ever looked at as consumers or just the general population as product. And they should be managed like product. And they should be marketed like product. And I think somewhere, I don't know how we got here, but it's become a place where there needs to be a new voice. And we cannot keep going with the winner-take-all mentality. And I get it, like that's capitalism, and I'm a capitalist, and I'm a competitor, trust me. But I do not believe the current frameworks are going to work, and I'll tell you a couple examples. We have customers who will never be on Amazon Alexa. They'll never, ever be on there, some of our brands, because they will not give their business and the insight to Jeff Bezos. And that's going to prevent them from being in homes potentially. There are people who won't advertise on Facebook because they know their data is going to be viewed. There are things going on that it's just not good for our overall business. And my greatest concern is that the tech CEOs, and I'm one of these, we're going to start being looked up in a very negative way. And that's not what we're all about. It's not what I'm about. And I think it's a good book to look at how did it happen? How did Facebook get there? And I just wish that the leadership, the one that's known, would just kind of mea culpa and be like, look, it's time for change, versus everybody about stuff and then hoping that it'll go away, or hiring people to lobby in Washington to make it go away, when ultimately I think as a citizen, I feel like there's something fundamentally wrong with these businesses, and it's got to stop. So that's the book I'm reading now. And
well, I think a lot of people would agree with that.
He's a great. He's got a good insight about the stuff.
Yeah, I think a lot of people would agree with the sentiments that you just laid out for us there. Hey, listen, Rob, this has been a real pleasure. I appreciate you taking the time out of your day to speak with us. I know you're a busy man. What you've done with LivePerson to date is just phenomenal, and I can just tell from talking with you the passion that you have for this business. Thanks so much for taking the time, Rob. I hope to talk to you again soon.
Okay, have a good one. Thanks, Jason.
And joining me in the studio via Skype now, as always, is certified financial planner, Mr. Matt Frankel. Matt, how's everything going?
Oh, just great. It's a beautiful day down here. It hasn't rained in 4 days, which I think is the longest stretch we've had all winter. So it's a good times in South Carolina.
Yeah. Well, I guess, man, I tell you, we've got a little bit of some overcast weather up here, but it seems like spring is just around the corner. So, maybe just a few more days of this winter stuff to deal with. Man, I tell you, I was watching the players on the golf championship, and it just got me thinking about Augusta. Man, already thinking about Augusta, Georgia, the Masters. Just a lovely time of year, not too far away. Okay, listen, let's steer away from golf here for a minute. Let's talk about banks, because this is industry focused financials. Matt, I set this up in the beginning of the show here. We were reading through an article last week about Wells Fargo's CEO, Tim Sloan, and it looks like Mr. Sloan got a little bit of a raise for 2018. And I guess the question that's on everybody's mind right now is, did he really deserve it?
Well, I'm going to argue for and against this. And so before I start getting, hateful tweets, just bear with me for a second. Well, first of all, just to put everything in context, his total compensation went up to $18.4 million, which is $1 million more than last year. Now, whether you think $18.4 million is too much for any one person to be making, that's another issue. But the raise is the issue, and his base compensation really didn't go up. His base salary of $2.4 million is the same as it was last year. And his stock-based compensation actually went down, which makes sense because, Fargo's stock's done so terribly. Where he got more money was that the board decided to give him a $2 million bonus, which he didn't get at all last year. So that's the issue here. Now, first, to put it in context here, I'll argue for it first. To put it in context, Sloan is still actually one of the lower-paid bank CEOs, even with this raise. Jamie Dimon made $31 million last year. Brian Moynihan made $27 million last year. But to be fair, those guys weren't running banks that had, 10 different scandals and all kinds of stuff like that going on. Now, we don't know what the bonus itself was actually for. This is kind of the argument where I want to know a little bit more before I rush to judgment. Now, let's say when he took the job as CEO, he agreed to a certain amount of travel days, a certain amount of times testifying in front of Congress, things like that, and he wound up having to do more. Maybe the board decided to compensate him for that extra work. I know at the Motley Fools, sometimes I get assigned a project that turns out taking twice as long as my boss intended it to, and they wind up, giving me a little bonus for it. So maybe it was something like that. I'd want to know a little more.
Makes sense.
So, and it's really tough to make the case that Sloan has not put fixing the problems at Wells Fargo as his number one priority. If you read either of the last two annual reports, they issued a separate report earlier this year about all the way they've changed the culture and some internal changes they've made. So those are kind of the arguments for that why he might deserve a bonus. Now, having said that, again, don't get on your Twitter just yet. Now, the arguments against it are, one, the bank still hasn't made enough improvements to satisfy the Federal Reserve, whatever the Fed's looking for. Remember, there's that big penalty that's still in place that Wells Fargo is not allowed to grow. So this guy's running a bank that isn't growing.
Yeah, that's a good point.
Right. And number two, it's not like Tim Sloan was brought in from the outside to fix the problems. He was already there. Tim Sloan was the president and COO of Wells Fargo while all these scandals were going on. So in a way, it's like he's cleaning up his own mess.
Yep.
This is why politicians like Elizabeth Warren think he should be fired.
Well, but I think you make a good point there, because I was going to maybe cut him a little slack and saying, you know what, maybe this wasn't really, maybe he's kind of coming in here and helping clean up a culture that obviously was out of whack. But I mean, the fact remains, you're right. He wasn't hired from the outside. This is really partly a mess of his own making. Whether he was CEO or CFO or COO, it doesn't matter. When you're in that executive suite, I mean, even if it's, just perception is everything. And there's no question that he had a part to play in what really broke this bank to begin with, right?
Right. And that's why, Elizabeth Warren and a lot of other politicians think he should be fired, not getting raises. Yeah. Because it's his mess. He should be, in a lot of people's minds, he should be lucky to have a job at all after all the, thousands of consumers who were taken advantage of, admittedly, by the bank. So there's some gray area here. Like I said, he's still on the low end of the pay scale for bank CEOs. He has done a good job, in my mind, of trying to rehabilitate the bank's image and making some cultural changes and things like that. But on the other hand, has it been enough? Maybe not. And this is his mess to begin with. So, like I said, I'm torn. Yeah, it takes a little while, too. I think it's always worth mentioning. I mean, it's not like you just turn this ship around overnight. I mean, that is a big company, and there were several points of failure. And so to clean that mess up is going to take a while. I feel like they probably would have been better served to bring in someone from the outside, because I think that's an easier message to communicate, but they chose to go another way with it. Fine, whatever. When you do that, you have to recognize this is going to be a problem that you're going to deal with. And, again, perception oftentimes is reality. And when you have that headline saying that the CEO of this bank who's just been screwing everybody left and right just got a raise, people are going to be mad. I get it. So, yeah, make sure to tweet at TMF Math Guy for all of your controversial. Just kidding. Don't give Matt a hard time. I think you played that one very well, Matt. You look at it, you fair look at both sides of the coin there. And let's jump into Twitter here real quick, because we got a good question over on the Industry Focus Twitter feed. I think it was yesterday, maybe the day before, but it was from Jerry at GSLO Shake. But Jerry asks, can you explain why conglomeration is viewed as positive for companies like Berkshire Hathaway, Markel, and Boston Omaha, but not General Electric? Is it all about the insurance angle, or is it more about a track record of smart acquisitions? Thanks for the great podcast. Jerry, thank you for the kind words. Thank you for listening, and thank you for the question. Matt and I agreed this was one we wanted to get on the show here today, because it's a fun one to sit there and talk about a little bit. Matt, what's your first take here? Well, there's actually a couple of different questions contained in that tweet. So let me tackle them one at a time. First of all, it's not that conglomeration is a bad thing in GE's case specifically, or that because it's a non-insurance company. The problem with GE is leverage. Right now, I think, or actually as of the last quarter, about 75% of GE's capital structure is debt. That's not sustainable. And it's how they conglomerated. In the early 2000s, their GE Capital, the finance arm, started to get a little bigger, and then started to take on products that it was never really intended to do. It was really just meant to supplement GE's other businesses, providing financing for things they already make. Right. But they got into, subprime mortgages and things like that, that any company that got into subprime mortgages in the 2000s was not doing well. So it's not that they didn't work. I would point to a company like 3M as an example of a non-insurance conglomerate that really works. 3M has healthcare operations, chemicals, consumer goods, you name it. Yeah. So it's a question of leverage. So that's point number one. Point number two is the insurance angle. It's not necessary, but it definitely helps in terms of the leverage financing angle, because insurance companies are a provider of very low cost, or no cost actually, capital. Warren Buffett mentions the float from time to time, meaning that all the money that is brought in from his insurance businesses before it's paid out, in the meantime, can be invested for the company's benefit. They don't have to pay interest on this money or anything. It's just, imagine if someone gave you $100 billion that wasn't yours, but you got to keep every cent that was made by investing that money. That's a lot of capital that's essentially free. So that's why the insurance business is really the fuel that helps some of these conglomerates that you mentioned.
Yeah, and I think one point also to remember with insurance companies is because they are beholden to certain guidelines and rules and regulations in regard to how some of that money is invested. I mean, some of that money has to be placed in low or virtually no risk bond or other fixed income instruments. Now, not all of it. I'm not saying all of it, but they do have to mind that. So there is a little bit of a risk tolerance there, I guess you could say, and that that they're not going to completely go off the deep end and just make all of these bad investments with all of that float. There is some protection there, I guess. Wouldn't you say?
Yeah, that's a very important point. You have to be good at running an insurance business for this model to work, which obviously Warren Buffett and his team are. Markel's another one that's really good at running insurance businesses. Boston Omaha is up and coming. It remains to be seen, really. I'm hoping that they eventually, I mean, not just because I'm a shareholder, I hope that they grow into an insurance operation like Markel or even Berkshire. But you have to be good at running an insurance business first. If you're not running an underwriting profit, then, all the float in the world isn't really going to help you that much over the long run.
Yeah, that's a good point. And I mean, it's worth noting, I mean, Boston Omaha and Markel are businesses that, they're running their businesses in that Berkshire mold. I mean, they look to Berkshire Hathaway as sort of the North Star. They're thinking, hey, these guys did something and did it really well. We'd kind of like to do the same thing there. And so they're running their businesses with similar philosophies in mind. So certainly, Jerry picked out a couple of good examples there in Berkshire, Markel, and Boston Omaha. And looking on the flip side with GE, clearly, GE was mismanaged from a number of perspectives, but all great insight as usual, Matt. Appreciate that and appreciate the question, Jerry. All right, it's that time of week. We're going to wrap things up here, Matt, but before we do, we want to give our listeners one to watch. What is your one to watch this week?
Like Fidelity National Information Services, ticker symbol FIS. They just announced they're acquiring WorldPay, which gives them an instant #1 market share with payment processing, which, I mean, if you could buy an instant #1 market share in the up and coming payment processing business that we're always raving about, that's a pretty good move in my book.
Yeah.
If you're not familiar, WorldPay is the #1 market share in merchant payments, primarily focused on e-commerce. They process about 40 billion transactions per year, not dollar amount, 40 billion individual transactions.
Wow.
So this is a big, big merger. They're getting $35 billion for the company. It's a cash and stock deal. And as would be expected, Fidelity National's stock actually dropped a little bit after the merger announcement, which is what normally happens. Usually the acquirer drops a little bit because they're paying a big premium. They're taking on some debt, some uncertainty in execution risk and actually achieving the cost savings that they're claiming. But they already have a big market share in helping banks process credit card transactions and help service auto loans for banks. So this also gives them the #1 market share in payment processing worldwide, which in my mind is a really nice business combination going into this cashless society over the next decade or two.
All right. I'm going to go actually with another company that we cover a lot here, a couple of companies really that have been made a little bit of news here. I called out Mercado Libre a couple of weeks ago, and this week I'm going to go with PayPal because if anybody out there was following the news, they would have seen that Mercado Libre recently raised close to $2 billion in equity offerings here. Which on its own is impressive. I mean, I think that was a good move. They took advantage of the share price, being nice and high at this point in time. But the neat thing was that PayPal invested $750 million in Mercado Libre. And that to me is telling from a number of angles. But first and foremost, when we talk about Mercado Libre as more than just an e-commerce company, it is certainly a payments company as well. And we saw this most recent quarter, their platform, Mercado Pago, is processing a lot of dollars through that network. Granted, when you compare it to something like PayPal, it's kind of a drop in the bucket, but you got to start somewhere. And it's nice to see that PayPal and Mercado Libre are partnering up there. And it's always interesting to me to think about how so long ago there was this connection between Mercado Libre and eBay. And we know that PayPal came from eBay, and now there is no connection between eBay and Mercado Libre, but there is now a connection between PayPal and Mercado Libre. So all to say, you probably want to invest in PayPal and Mercado Libre and just leave eBay alone. But anyway, I think it's just a neat angle there with PayPal. Good to see that they are investing in that global payments network, and good to see Mercado Libre taking advantage of it. So I think with that, we will call this a show. Matt, as always, I appreciate you taking the time to jump in with us this week.
Of course, it's always great to be here.
All righty. As always, people on the program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against, so don't buy or sell stocks based solely on what you hear. Today's show is produced by Austin Morgan for Matt Frankel and Rob LoCascio. I'm Jason Moser. Thanks for listening, and we'll see you next week.